On the 25th of January, I made perhaps what could have been one of the biggest investing mistakes of my life. And I'm going to tell you what happened and show you exactly what you should do if you find yourself in a similar situation. And it would be quite easy for me to just push this under the rug and hide away, but that's not what I'm about. I told you I'll show you the ups and the downs, so here is one of those downs. To understand what happened, let's go back to earlier this year. One of my favourite ETFs was down and looked like good value. HRUB. Yep, a Russian ETF. Tensions were rising between Ukraine and Russia, which caused the price to dip quite considerably. I'd held the ETF in the past, and it's full of big oil companies, which, regrettably, the world still is so reliant on. So I bought some. Russia then moved troops to the border of Ukraine in what I thought would be a fear tactic. Then, as a good old strategy goes, dollar cost averaging, I bought some more. Then some more. Then some more. More. And oh yeah, more. It can be like adding a fuel to a fire you just can't put out. Then this happened.
The war in Ukraine breaking overnight.
The largest conflict on European soil in more than 70 years.
I want to be honest with you. This could be a long and difficult battle.
And Russia closed their stock market. Tough sanctions placed on Russia caused companies listed on international markets to plummet. And you might wonder how this happened when the markets are closed. Well, they do this through advanced proxies and algorithms which essentially allow them to pretty accurately predict the price of the stocks with surprisingly good accuracy. In fact, when this happened with Greece, they opened at pretty much the exact price. My last purchase was actually after the market had closed in an attempt to lower my average price per share. Now this is where you say, Chris, WTF. How could you support the war? Where are your ethics? Well, my somewhat unpopular opinion is, ethics are very hard when it comes to investing. It's almost impossible to work out what actually goes on in a lot of companies. In fact, if you're completely ethical, you probably shouldn't buy any kind of index funds because there's companies within them that perhaps aren't very ethical. There's oil companies, big pharma companies, and companies that probably don't do the best things with your data. Now, I am fairly ethical in other areas of my life. I don't eat meat and I try to be as eco as I can. With investments, I try not to worry too much about ethics like some people don't worry about eating meat. And I think that's okay. I also believe, despite Russia being branded as one big evil supervillain, there's plenty of good, hard-working families that work at these companies who rely on it for income. But there is no denying that the whole situation is terrible. And what came next? War, which honestly I didn't expect. And it's okay to admit that I was wrong. This left me with a 70% loss on my investment of $28,500, which now stands at $7,000. Ouch. So I've lost a ton of money. Congratulations. So what? Well, I'm showing you this because it's the exact moment that I believe most investors will fail. And because if you've started investing in the last 3 years, it's likely that you will never have experienced a loss in your portfolio because the whole market has been going up quicker than Elon's race to Mars. Likely because he's too busy trying to have a 1v1 fight with Putin. But this does raise the question, what do you do when your portfolio looks more like a bloodbath than the green summer meadow you've been dreaming of? Well, you need the 3 Ps. No, not those Ps, these Ps. And I'm going to show you exactly how this relates to my situation so you can do the same in yours. First, purpose. This is where you find yourself looking back, scratching your head and thinking, why did I buy that? I bought the ETF because it was down due to conflict, it's given me good returns in the past, and it's made up largely of energy companies that we need. And I thought that things would blow over. Boy, was I wrong. And oh yeah, the chunky dividend didn't hurt either. Now this is where you need a clear purpose for buying the company or fund in the first place. Remember, when you buy, you need to be looking for value. A company or fund that represents good value that you expect to rise in the future and know why it will, or at least why you hope it will rise. The second is plan. Having a plan is not something that a lot of people like to do, but if you're investing, it's crucial. At what points are you buying those shares, what's your target, and what are you going to sell them at? When I first bought this ETF, it was around 808 per share, around 20% down from the previous months at 1000. My plan was to buy and hold this ETF for some considerable time, a minimum of 3+ years. I then planned to continue to average into this position as the price dipped, which I did a further 6 times. My average price is now $595, which is lower than the lowest point in the last 5 years, which was 657. Now, while that's great, the price today is 177. 70% down from that position. It's also important to realize the threat. Obviously, in my position, a war isn't great. My biggest threat that companies could either be delisted or forced to delist. Being aware of your biggest threat is super important. Just looking at the good points of a company is never good. That's why when I post on my Patreon what I'm buying, I post the risks every time, because you need to be clear of the risks in every investment. Oh, and if you want to come and join that, do come over and say hi. Risk management is also important here. While the positions took a huge hit, it's only 28,000 out of my entire portfolio, which is about 1/5 of my total investments, which I'm pretty okay with. This is where we move on to the third P, which is patience. This is where 95% of investors will go wrong. Panic selling is the number one thing that will cause you to lose your money quickly. Remember that plan I made a minute ago where I said I was holding for 3+ years? Well, that's the point where I take a step back and look at my timeline. I've held this ETF for 3 months, when actually my investing timeline is more like 30 years. At this point, the best thing to do is simply not look. And this is what you should be able to do with all of your investments. You aren't the next big day trader who's making 10k profit a day trying to time the market. You are buying long-term value-based investments where you could uninstall your investing app and check it again in 10 years time and you would be in profit. In fact, I challenge you, buy an ETF, set up regular investing and just delete your app and see where you're at in 5 years time. And this is what the majority of successful investors do. They have a hands-off style approach to investing and focus on making money, because more money will rapidly increase your portfolio, much more than your returns will. Now, if you want to see how this whole pans out, do subscribe and follow along because I post it all right here on the channel. You can check out this video of my portfolio where I'm building from 0 to 100k. And if you want to stay more up to date on this, come and check out our Discord. I'm going to open up some more slots on the Patreon at the promotional rate, so do keep an eye out for those. And hopefully this video has shown you that I am just as human as you.